our great lineup of panelists that we have again today. Our moderator is Carol Gawker. Carol is a lead tax partner out of our Harrisburg office. She's been with KPMG almost 20 years now and is also the office managing partner of our Harrisburg office. Ann Holly, this is her second tax coffee chat. She's our national, state, and local tax practice leader, and she's been with KPMG over 26 years. John Steeden is our state and local tax partner based out of our Philadelphia office, and he's been with KPMG 13 years now, specializing in income and franchise taxes. Jeremy Jester is a managing director out of our Tyson's Corner office, and he specializes in indirect sales and use tax. Jeremy recently rejoined KPMG, and we are delighted to have him back with us. Dan DeJong is a senior manager in our Washington National Tax state and local tax practice. Dan joined KPMG almost 6 years ago. And last but not least, we have Derek Jones, who's a senior manager in our Pittsburgh office, who has been with us over 10 years now in state and local tax. So with that, Carol, take us away.
Thanks, Pete. We're going to start off with a CPE question. You should see it in your poll everywhere. We'll just take a few minutes for everyone to respond. Responses are starting to come in. And while we're waiting for the responses, can you talk to us about some of the state tax issues created by employees working from home?
Sure, Carol. Let's dive right into that point. I guess the first thing I think we have to set the stage that when we entered into the current situation, many companies started having their employees work remotely. And, you know, at the outset, I think many people viewed this as a temporary thing. And as we talk to more and more clients, we are hearing that this could become more permanent than what people originally thought for a variety of reasons. And so I think while at the outset, some of the issues that were potentially created, we may have minimized the potential impact because we did think that the work from home environment was going to be much more short-term in nature than we had originally thought. And we've seen some of these issues, quite frankly, drive decisions within companies about how and to what extent they're going to let their employees continue to work from home. So with that as a backdrop, I want to kick it over to Derek and Jeremy to kind of dive into some of both the income franchise and the indirect tax issues that relate to companies allowing their employees to work from home on both a temporary and a more long-term basis. So Derek? Derek, maybe you're on mute.
Thank you, Ann. I was just saying good morning, everybody, and thank you for joining. On the income tax side of things, we've been thinking about it in terms of both Nexus and then also the apportionment impact. So maybe I'll start with the Nexus consideration first, and that is with having employees working from home, that it might be in the same state, it might be in a different state, or even on a local level, it might be in a different jurisdiction. So the first question that you need to ask is what is your employee doing and where are they doing it? And from there, it's an analysis then of is the activity that the employee is doing in their home or their temporary work location, is it a Nexus creating activity? Does it trigger an income tax or other state tax filing requirement? I think the next step to sort of walk through then is, depending on the activity, does it fall under 86272? We've always thought of 86272 as it saves you for having the traveling salesperson for going into a state. But what if the person working from home is an accounting employee or a marketing employee or some other type of employee that doesn't really fall under 86272? Then you probably have a Nexus issue. And I work a lot with public utility companies, and they are typically pretty jurisdictionally bound, where one utility just operates in one state, and so they didn't really have a ton of Nexus issues in the past. But with mobile workforces and having accounting people spread out and people working from jurisdictions, this has kind of been bubbling up for a couple of years now. And so at a conference last fall, I had pulled some cases at the time that analyzed what having a remote employee, whether it's accounting, whether it's an IT professional, whether that creates nexus. And I was pretty surprised to find the states were in pretty uniform in their decisions that having that remote employee does create nexus. You can look back to the Telebrite decision out of New Jersey, where having an IT professional who was doing coding from home, one employee in the state created nexus. Idaho also issued a ruling, and it was the same sort of facts as Telebrite. One employee in the state doing IT coding creates nexus for income tax purposes. And then there was even a Virginia ruling out there that I found that said that having an accounting employee at home did create income tax nexus. So it was interesting that all of those rulings were before the COVID outbreak, but at the same time, they were pretty uniform in their decision that having that one remote employee really did create an income tax nexus filing requirement. I then say, okay, so having that employee in the state, does it create nexus? Move on to, does the state have any sort of de minimis rule, or does it have any other temporary waivers or any notices out based on the emergency, which is the coronavirus? And I would again point back to some of the public utility work that we've done, where when a hurricane hits an area, several brother-sister utilities will send their crews to the coast to hurry up and try to get electricity and regular services back up as soon as possible. And most of those governors have issued waivers at the time of the emergency saying that just by sending in your crew to help in that state on a temporary basis, it doesn't create nexus, it doesn't create a filing requirement. And that really does parallel sort of the current situation where initially you had so many governors issuing temporary waivers through certain dates that if you work from home, it doesn't create nexus. But as we're moving through the summer and some of those orders might start to expire, I think the question really does arise, do you have nexus in a lot of these states? And is that something that you might need to consider for your provision and for your filing footprint? The nexus consideration, I then move on, well, what is the impact? And that's sort of the apportionment side of things. And although the payroll factor is the one that you might think of most because now maybe you have employees in different states and that changes a little bit. A lot of you might say too, well, most states have been moving to single sales factor. I'm not sure how much the payroll factor is really going to impact my overall apportionment to begin with. And then number two, maybe you don't have enough employees that are moving across state lines that it really drives much of an ETR differential there. But I'd also say look at the sales factor. And most importantly, on some of the intangible or maybe some of the service sourcing things, if you're an income producing activity state or cost of performance, we would typically look to see where the actual activity that's driving that revenue is taking place. And if you have employees now that are working from home and those employees are the ones that are doing the actual service or the revenue generating activity, might you have a shift in the way you need to source some of your sales? And then on the market-based sourcing side, does it matter that maybe if you were allocating any sort of intercompany revenue streams or even to other customers, does it matter that the person receiving the services might not be in the same location anymore? And the big question is, how long is this all going to last? If you're expecting that this might be the new normal and that things might continue this way in the future, are these some sort of permanent adjustments you might need to make for your Q2 provision as we come to the end of June here? So all some considerations on the income tax side of things, both nexus and apportionment. The other thing I just wanted to mention quickly before turning it over to Jeremy on the sales tax side, I've been getting a lot of questions, even on the payroll tax side of things for employee withholding and different things. I had a client that was looking to hire an accounting employee down in South Carolina. And the question there was, okay, well, what do I just need to remit for this person in South Carolina now? They also had several employees who worked outside of the state for their house, but they reported to a location in the state. And does that change the way I need to withhold? And the general rule was always that you need to withhold when based on the location where you work. I had some clients who would withhold also as more of a convenience to their employee for their home state, even if the company wasn't in that employee's home state. But this is another thing to kind of think about. You need to take a fresh look at your employee withholding process and see where you're really sourcing. I point out that it was interesting over the last couple of weeks. There have been quite a few state and local tax articles in the Wall Street Journal. So it's always neat when we get some press in state and local tax. But they were talking about New York and the unincorporated business tax, and even some of the payroll taxes there too, where employees are now not working in the city center; they're working out at their home in either the Hamptons or New Jersey. And New York City is still requiring that the payroll is sourced to the business location, or the location where the operations are sort of directed and where they've always been, and that's still New York City. There was another article about a New York University law professor who worked at NYU in New York City, but his home was in Connecticut, and he actually paid tax twice on 100% of his income, both to New York City and then also to Connecticut, his home state. So just some other issues there. We could probably have a whole session on payroll tax alone. Maybe that's another one for another day, Carol or Pete, as we continue the coffee chat series, but just wanted to bring it up because we have been getting more and more questions on it. And with that, I'll turn it over to Jeremy.
Thanks, Derek. I mentioned this recently, I think last week, that I'm originally from Pittsburgh, and come from Pittsburgh, everyone's hero growing up was Mr. Rogers. And he said during these scary times, look for the helpers. And look, we're doing taxes, we're not saving lives or anything like that right now, but we hope that some of the issues and opportunities we're talking about can actually help you in your business in the long run and short run, help them get up and run as soon as possible. So, as difficult as these things have been, there are some real indirect tax opportunities and issues that I want to walk through right now with working from home. And a little bit later on, some more opportunities too we're going to go through. So one is you want to revisit where software is being accessed right now. I almost said purchase, which would defeat the purpose of what I'm going to talk about, because as most of us know, many states tax software purchase based on where the user is located. So this work from home environment changes that location where certain purchases are used from the company office to now our residences. And so not only the taxability, but also the tax rate could vary as the location changes. So a good example is if you have a company and your office is in downtown Philly, you're going to be subject to the 8% Pennsylvania, 6% state tax rate and the 2% Philly county rate. Now, if most of your folks and your employees are now live in Bucks County or outside of Philadelphia, that tax rate is going to be 2% lower. So that's an example of the tax rate changes. Another example would be if you have employees who live in Delaware, so they're accessing software that's not even taxed anymore. So what do we want to do? What is this opportunity here? So you want to look for your existing software, your software maintenance, any types of information services, information retrieval services, and data purchases that are now being used in different locations than just, say, Philadelphia or even Pennsylvania. A great example is I live right outside D.C. in Northern Virginia. Northern Virginia doesn't tax electronically downloaded software. But if I worked in KPMG's downtown DC office, I would be mostly accessing our software in DC, which taxes almost all software. So now that I live in Virginia, KPMG would want to reallocate that license to Virginia and not have to pay sales tax or accrued use tax on these software charges. So another opportunity is you want to make sure you're reviewing your equipment and services that are being used to actually support these work from home activities, as there are some pretty significant indirect tax impacts. So here, as background, certain states, they could have specific exemptions that apply to COVID related purchases or purchases from companies that are typically taxable, but may now have non-taxable components due to COVID. So this includes things like masks, gloves, disinfectants, cleaning related services, janitorial services. You're now buying more than you ever have, extra furniture, partitions, a reconfiguration of the offices, interior design services. So what to look for here is, you want to look at make sure your procurement system is set up to tax and review the taxability of these certain purchases. And the last opportunity I'm going to talk about, it's a specific New York City opportunity that hasn't really been, it's almost an issue of first impression. So it's a New York commercial rent tax opportunity. So the New York commercial rent tax is essentially 3.9% on rent exceeding a baseline of like $200,000, $250,000 for commercial activities. So as we know, Governor Cuomo prohibited companies from operating in New York City. So there's an argument that the commercial activity was not able to be performed during those times that the city was shut down. So this is not a clear-cut opportunity just yet. It may mostly apply to retailers and those companies that were completely shut down, not just offices where certain personnel could come in, maybe mailroom employees. But these are just examples. And there's also a similar opportunity in Florida for their tax on lease payments. So these are just some specific opportunities that are percolating up due to working from home right now. So, Ann, I think Carol, we're gonna swing it over to you now.
Thanks, Jeremy. So most of you responded that your employees are working from home and are expected to continue working from home. If anybody has any questions, feel free to either unmute your line and ask your question or raise your hand. You should see a little hand next to your name in the participant list. Alicia, do we have any questions?
Nope, not yet.
Okay, great. Thank you. So polling question number 2 should be live for you guys to respond. And again, the polling questions are how you'll be eligible for CPE. And with that, Jeremy, can you talk to us about some of the other things we're seeing from a state and local perspective, not only related to employees working from home?
Yeah, absolutely. So, feel free also to ask questions. This is a coffee chat. More than happy to. If you want to raise your hand, this can be a back and forth here too for all the attendees. So some of the other COVID issues, as macabre as it seems, there are a number of cash savings opportunities and some potential issues we're seeing out there. So issues is one is the taxability of expenditures. So for example, safety apparel for non-production activity. Manufacturers and companies like that are they know what they're purchasing and whether it's taxable or not when it comes to safety material. But for those of us that normally don't buy these types of items, you want to make sure that there's you're taxing or not, you're being taxed or not being taxed appropriately there. Companies are spending more to clean, so you need to review potential exemptions and taxability of these materials and services for cleaning, sanitizing, social distancing measures. For our manufacturers in the room, make sure you are revisiting this manufacturing process. If you've done any retooling, extra sanitizing, if for the companies that are now making PPE that they never have, maybe some of these sales are made to tax exempt entities, or these sales are just typically not taxable to begin with. So make sure you're not overcharging sales tax, and for those company buying these things, maybe these aren't taxable. You want to look at the taxability of the purchase of PP&E. Another one is VDA payment plans. So there's always been a handful of states that have allowed you, when you do a VDA, to not have to make a one-time lump sum payment, because I've worked with a number of clients that they want to get their history cleaned up, but they worry about dropping that $2 million in 3 states for a VDA. We've helped a number of these companies in the past to go on a payment plan. And there was a recent multi-state tax compact poll out there that the states aren't officially saying that they're going to allow more payment plans, but they will allow it to be as part of the negotiation process. So keep that in mind if you're looking to do a VDA in the near future. Another a couple opportunities are property tax impairments. So this is sometimes a forgotten opportunity. Here you want to focus on the valuation reductions of your property, asset impairments, reviewing ghost assets, all these things to help reduce your personal property tax liabilities. So here, some states are allowing for real property tax values to be reassessed due to a decline in value. So especially when a disaster declaration has been made. So as we know, a lot of states have officially declared a disaster. So if that's the case, you want to look in those states to see if you're subject to personal property tax, if you're subject to real property tax, and if you have an argument to reduce the value of those property items. So some cash savings opportunities. As we know right now, cash is king in a slowing economy. So we're seeing a number of companies looking to improve their cash recovery and cash optimization. So this includes things like implementing or even thinking about a centralized procurement company. Most folks know about this, but if you don't, this would allow you to defer your sales tax over the life of a lease, or you wouldn't have to pay use tax or collect sales tax when items are pulled from inventory. So you would create a ProCo company, makes all of your purchases on a exempt sell for resale basis, and you don't have to worry about relying upon your vendors charging you the correct sales tax. And then you have the control and insight and clarity on when you're going to charge your related entities sales tax when you actually pull it from inventory. So you don't have to make that sales tax payment up front. You only have to make that sales tax payment when you actually pull it out of inventory. There's also potential property tax savings with this, as well as numerous income tax savings here. So there's a restructuring opportunity here too. You also want to review your operating costs. So a good example of this, especially in Pennsylvania for our manufacturers, is you want to re-update your engineering studies and make sure you're taking an appropriate utility exemption. Some Pennsylvania, they require you to perform an engineering study if you're going to take an exemption on sales tax on your utilities. So how long has that been? Have you increased your production? Have you increased your manufacturing? If so, you may want to redo that engineering study so you can take full advantage of that exemption. And another one you want to really be aware of is reviewing your credits and incentives you have in place. So you want to make sure that you're going to meet those committed thresholds for new hires and capital expenditures and things like that. If there's any chance that you may not meet those thresholds and you could lose those credits and incentives, or they can come back and do a clawback and get some of those savings that you took advantage of in the past, get in front of those jurisdictions now or sooner rather than later. So you're talking to them before you fail to meet that threshold, because a number of them will work with you on that issue. And the last thing I want to point out, you want to be aware of, a number of states, especially in the Mid-Atlantic region, have had payment relief packages for a number of states, or a number of taxes, especially for indirect taxes. Here they would delay your payment of sales tax. You don't have to pay for 2 or 3 months. You can be late without interest and penalties. However, a number of these relief packages have lapsed. And the one that's still out there in our region is PA is still not requiring the accelerated sales tax prepayments for April, May, and June. So we haven't seen anything out there for July and beyond. So be aware of that. So like I said in the beginning, let's make this a real true coffee chat. If you have any questions, feel free to reach out. But know that there are a number of opportunities and pitfalls you want to be aware of due to COVID.
Thanks, Jeremy. Alicia, we'll just take a pause. Do we have any questions? Again, guys, you can raise your hand or unmute your line if you have any questions.
No, I do not see any questions at the moment.
Thank you. I believe polling question number 3 should be live. Dan, I'm going to throw it to you. We've talked a lot about the CARES Act and the federal implications of the CARES Act. How have the states reacted to the CARES Act, and what should we know about that?
Hey, Carol, thanks for that. Yeah, I think beginning especially with tax reform that passed at the end of 2017, and now with the CARES Act that was enacted at the end of March, what we're really seeing here is, for state tax nerds like me, conformity is really a cool thing to talk about these days. And unfortunately, it's also pretty complicated. And so we're getting lots of questions from clients about what these provisions in the CARES Act mean as they filter down to states and the calculation of state taxable income. And really high level, all states with a corporate income tax to some extent incorporate the provisions of the Internal Revenue Code into the determination of the state corporate income tax base. And generally they do that in one of three ways. Either they are static conformity states, so those are states that have a law that says something like, we conform to the Internal Revenue Code in effect as of a certain date. And other states have a rolling conformity methodology, which means that their statutes read something like, we conform to the Internal Revenue Code as amended from time to time. And in those states, you'd have the effects of an amendment to the Internal Revenue Code like the TCJA or the CARES Act automatically becoming effective in those states because they're always up to date based on whatever the current version of the Internal Revenue Code is. There's a handful of states out there that we call selective conformity states. They generally conform to select provisions of the Internal Revenue Code. And in those states, the provisions of the Internal Revenue Code that they conform to are generally set on a static conformity basis. And so when we take that more general background and apply it to some of the specific provisions within the CARES Act, we come up with a few different types of thought processes for ways to go through how this applies to me in my company. And so I'll start with the changes in the CARES Act to 163J, the interest limitation. And there, the CARES Act increased the percentage of ATI that served as the limitation for the interest expense deduction from 30% of ATI to 50% of ATI for 2019 and 2020, and allowed taxpayers to elect in 2020 to use the 2019 ATI that they had, probably assuming that people's ATI in 2020 might be lower given some of the impacts of the COVID-19 situation. So in states that are rolling conformity, I think the general approach is that they conform to these revisions to the Internal Revenue Code in the CARES Act. And now we're watching for those rolling conformity states to enact specific provisions that either decouple or somehow modify their conformity to that provision. And New York's a good example of this. Back when they passed their budget, which was right after the CARES Act passed, they had some provisions in their budget bill. And now just for a moment, remember that New York is a rolling conformity state, so it would automatically conform to these CARES Act changes. They had some provisions within their budget bill that talked about what they were going to conform to as with respect to 163J. And what they said was they were not in New York State going to conform to the change in percentage of ATI. So they would not conform to the 50% of ATI election for 2019. So it's important for people who are doing their 2019 compliance now to understand that in New York, the 163J calculation is done using a 30% test of ATI, not the 50%. But it gets more complicated because there's a lot of details here. In the New York bill for 2020, they still do allow the use of the 2019 ATI. They just allow 30% of it to calculate the 163J limitation in New York for 2020. At least for corporations. And I think that's kind of an interesting nuance and a reason for your large states where you have a large state effective tax rate to pay close attention to the state legislatures and any guidance that the state puts out in this regard. Another state that I think we had thought we knew the answer to, but maybe not after some emergency regulations were released, is Colorado. So Colorado is a rolling conformity state, meaning that we would expect Colorado to automatically conform to changes to the Internal Revenue Code passed as part of the CARES Act. Making sure you guys can hear me here. I think I'm live. So you would think in Colorado that you would apply the amended CARES Act changes to 163J to the calculation of 2019 taxable income. However, Colorado put an emergency reg out there that says, yes, we are a rolling conformity state, but on a prospective basis only, which means that under their emergency reg, they're saying that for 2019, you would still use the 30% of ATI limit when calculating the 163J limitation for 2019, but in 2020, you would use either 50% of your 2019 ATI or 50% of your 2020 ATI. What that does is a couple things. It makes it difficult for taxpayers to do their compliance, and also it creates a potential for a Colorado-only tracking need for a 163J carry forward. Now, I think if you have a large 163J carry forward, taking care to monitor your Colorado numbers closely is helpful, because you might have a valuable deferred tax asset in the form of a Colorado 163J carry forward that you would want to make sure that you took advantage of, tracked, and kept in your records. The one other thing that I would mention is that even with COVID-19 being here and most state legislatures being on hold for the moment, Iowa actually passed last week legislation that updated their conformity to the Internal Revenue Code with respect to 163J, at least in 2020. So beginning in 2020, according to this new legislation passed last week, Iowa decouples completely from 163J. But they did that for 2020 forward, meaning that in 2019, they still conform to 163J on a static basis, meaning they conform to 163J for 2019 under the pre-CARES Act rules. So there's a lot of complication there. And the idea here isn't to make everyone the world's living expert on all of these provisions, but instead to just make people aware of the issues and to point them to the fact that it's not all negative. There are some opportunities there, and to keep those in mind. So that's 163J. For qualified improvement property, QIP, the CARES Act included a technical fix. So this related to the error in the drafting of the federal tax reform bill in 2017 that excluded qualified improvement property from the 100% bonus depreciation provisions that were a part of tax reform. And the CARES Act did this fix retroactively. So the CARES Act actually amended the TCJA, which is interesting as far as the retroactive effect of the CARES Act changes. And so here we have the same issues really as we did with 163J, meaning we have static conformity states versus rolling conformity states. And a couple things about this. Look at first your static conformity states to see if you have any situation where there could be a possibility of saying that retroactive amendment to the TCJA could have retroactive effect in those states. That would be a rare occurrence, but it's worth taking a look. In rolling conformity states, you have an issue of, does the state conform to bonus depreciation? If not, you might have to add back your bonus depreciation related to QIP as it appears on your 2019 returns. But because the QIP fix in the CARES Act really changed not 168K where bonus depreciation is located, but definitions within other places of 168 that wound up with qualified improvement property being given 100% bonus depreciation. What you have to think about is, were those other provisions within 168 that reduced the recovery period for QIP property from 39 years to 15 years applicable in my state? So that even though I don't get 100% bonus depreciation, I'm taking the appropriate amount of depreciation using the 15-year life, which could be still a benefit versus the 39-year approach. Now, this could be a compliance problem for people because the way that the federal folks and the IRS have asked taxpayers to amend their returns or catch up on the use of the bonus depreciation applicability to QIP property is through either filing amended returns for 2018 and 2019 if you've already filed your 2019 return, or including a 3115 accounting method change with a 481A adjustment on your 2019 return. And there's important tracking to be done, because if you have a 481A adjustment that relates to bonus depreciation that has a state modification associated with it, you need to look at that 481A adjustment and think through how you're going to report the add back with regard to that state in light of this 481A adjustment that relates to bonus depreciation. And so there's some opportunities there, I think, although on this case, I think it's more looking at it as far as making sure that compliance gets done correctly and everything's accounted for properly on the 2019 returns. One other thing I think here is the treatment of PPP loans. That's the Paycheck Protection Program. Under the CARES Act, there was a provision that allowed certain businesses to receive these PPP loans. And if those PPP loan proceeds were used for certain types of expenses, the CARES Act had a provision that would allow for forgiveness of those loans, and a special provision that said if the loans were forgiven, then that income, cancellation of indebtedness income, would be excluded from federal taxable income under the Internal Revenue Code. The only thing was the IRS looked at this and said, well, there's a provision in the Internal Revenue Code, section 265, that says you don't get to deduct certain expenses related to income that's not subject to tax. So under Notice 2020-32, the IRS came out and said, well, yeah, you might have loan forgiveness under a PPP program, and you might have used that for the appropriate reasons and gotten loan forgiveness, and now have no income associated with that cancellation of indebtedness income, but you don't get to deduct things like wages or qualified rent or qualified mortgage payments that you use those proceeds to pay for. And so some states who are static conformity states would say we don't conform to that forgiveness of debt exclusion from income under the CARES Act. So that's taxable income in our state. But because it's taxable income, you do get the deductions for those wages, qualified mortgage, and qualified rent. And so it's just another area where conformity, I think, can create some weird answers. You get to the same net result in that type of state, but you do it through a different mechanism to get there. Finally, part of the CARES Act had a provision that allowed companies to carry back NOLs that were generated in 2018, 19, and 20, 5 years, and it took away the 80% of taxable income limitation on NOLs for those 3 years. So what we expected to see and have seen a decent amount of is that taxpayers are electing to carry back these losses. It's nice because if you carry back a loss from 2018, 2019, or 2020, those are 21% tax years at the federal rate, and you could carry them back 5 years into a year potentially where the tax rate is higher at 35% before the TCJA reduction from 35% to 21%. And so the important thing there, I think, is that when you carry back a federal NOL, you may think that, hey, there's no change to state taxable income just because I carried back an NOL, because so many states have their own NOL provisions. And so I don't think I need to file a state amended return. But most states do require when you file a federal amended return, and in our research, a lot of states, even when you file a Form 1139, which is just a quickie refund claim for carryback of NOLs at the federal level, it does trigger the requirement to file a state amended return. And even if there's no change to state taxable income, it could open up those years that you've carried back the loss to. It could open up the statute of limitations for those years. So it's important when you're doing one of these federal carryback claims to just kind of analyze the states where you have the most apportionment and could potentially pay the most tax, and determine whether you're potentially leaving those statute of limitations open for those particular states. So just something to think about. And it's especially important when you have uncertain tax positions that may have been on those old returns that could have fallen off your UTP schedule because of the statute of limitations, where now if you've opened up the statute of limitations for those issues, it might be something that you have to keep in mind. And so those were a few of the things related to the CARES Act that I thought taxpayers are struggling with a bit right now and need to keep in mind as they go through their 2019 compliance and start to think through some of what they're doing on the federal side to account for the CARES Act changes and taking advantage of some of those provisions. And so, Carol, that's kind of what I had. It's pretty quick going through there, but there's a lot I think that folks need to keep in mind in that area. So what I wanted to do was pass it back to you. I think we have another polling question and then another really important section on restructuring.
Thanks, Dan. Polling question number 4 is open. So Dan, that's interesting. In my 20 plus years, I don't know that I've ever filed a state amended return when I filed an 1139. So definitely something to consider.
Yeah, it's wild. The research is crazy on that. There was one state, Delaware, where the Supreme Court of Delaware actually had a case that dealt with an 1139 and basically said, don't get technical with this. That's basically an amended return. And so I thought that was pretty interesting. I wasn't aware of that case before doing the research. So
wow, interesting. So a lot of us are obviously in Pennsylvania, since this is a Pennsylvania call. Jeremy, I think there might be some tax saving opportunities in PA. Anything we should mention?
Yeah, Carol, I just got a note from one of the attendees, Ben. Thank you for passing us along from the state that for those companies that and entities that are subject to a PA sales and use tax audit right now, that the state is going to, for any audit closed and assessed by December 17th, the state's going to grant an automatic penalty abatement. They're going to provide 90 days of interest relief, and they can also postpone issuing the assessment for 90 days as well. So that can be fairly significant depending on the assessment, and that gives you a lot of time. Not a lot, but gives you just under 6 months to close any Pennsylvania audits, sales and use tax audits you have right now. So I wanted to pass that along. Thank you, Ben, for passing that along to us. So that's, yeah, Carol, with since this is a Pennsylvania, a lot of us are in Pennsylvania. It's a fairly decent opportunity for folks to take advantage of right now.
Thanks. What were those dates again, Jeremy? Was it December?
December 17th, 2020.
Thank you. Got a client who might be interested in that. So thanks, Dan. I guess the other thing I was thinking about is relative to the CARES Act, is stay tuned, right? Because I think the one thing we've learned over the last 3 years, really, with all these federal tax law changes, is the states are rethinking their current either conformity or how they adopt these federal regulations. So I know some states have come out with some guidance, and I don't want to get this wrong, so I'll throw it to all of you guys. I think New York has specifically come out with some guidance on 163J. Again, there's Pennsylvania, New Jersey, a lot of folks here. Anyone have any thoughts on or want to share anything with how Pennsylvania and New Jersey specifically have adopted the CARES Act, or whether or not they have? I think Pennsylvania's put out some guidance.
Yeah, this is Dan, and it's not specific to those two states, but just one point in general is I mentioned that a number of states were having delays or postponements in their state legislatures meeting. And I think what that postponement or delay might be doing also is giving them a little bit more time to think about how they want to react to this, especially since I think state budgets are going to be in a tough spot coming up. And some of that's dependent upon federal legislation that would provide some much needed aid to states. But depending on that works, it'll be really interesting to see once state legislatures start meeting again, how they decide to deal with some of these items, because they might not be in a position to offer so many incentives to companies given their balanced budget requirements at the state level.
Thanks,
I don't know,
Dan.
Jeremy. Mm-hmm.
So with that, I know, lots of changes, not only Nexus, but perhaps which entities within the group are generating income versus, who had traditionally perhaps generated the income. John, do you want to share some thoughts about what companies are seeing and some planning opportunities?
Yeah, thanks, Carol. From the impact of the TCJA to the CARES Act legislation to material and potentially permanent changes to the business as a result of the pandemic, now's a good time to take a close look at your structure for opportunities. You also have the proliferation of state add-back statutes over the last 10 to 15 years, which has slowly eroded some of the state tax planning that we've done historically. So now's a good time to take a close look at your structure, make sure that it's state tax efficient, and make changes as needed. One of the big challenges that we see in planning and restructuring is not knowing where to start. Even in small structures, maybe 5 or 10 legal entities, it can be difficult to identify savings. And that only gets more complicated if you have 20, 50, 100 or more. So if we move to the next slide, we'll just talk kind of at a high level about a solution that we've developed to help assist in structuring. It's what we call the state tax analysis and restructuring tool. The tool takes pretty basic state tax information from a company structure, things like taxable income, state modifications, apportionment, et cetera. And then the tool applies a proprietary algorithm and analytics to that data to identify state tax inefficiencies. It then uses that information to propose multiple alternative structures based upon the company's priorities. Sometimes the main priority is reducing the number of legal entities. Other times we're focused on cash tax savings. And in other situations, the main goal is a financial statement benefit. Most of the time, it's some combination of all of these benefits. So we'll maybe the one other point that I'll make before we move to the dashboard is even if the tool doesn't generate a new structure, or the only structures that it generates are things that operationally you might never do, we found it to be a really great health check on the organization. So in a couple of situations where we thought we might be able to find some synergies, a client tells us, look, I don't think there's anything there. You want to run it, go ahead. And sometimes, we even surprise ourselves in that there are some state planning opportunities. In others, it simply validates the current structure. And sometimes that's pretty desirable, particularly when you have a large number of tax respected and legal entities. So moving on to the next slide, we just want to give you kind of a client scenario here and show you what the dashboard looks like. So it's a little bit hard to see on my screen, but the base case, this company pays on a yearly basis somewhere in the neighborhood of $4 million in separate state tax, and that's an important distinction here. The tool focuses primarily on separate state tax inefficiencies, and so we ran this tool, and what we came up with was roughly $2.25 million of yearly cash tax savings, which also used around $1.5 million of NOL. Importantly, as you dig into the details, and there are subsequent work papers that we won't show you, that $1.5 million of state NOLs, those came out of a balance that had a full valuation allowance on it. So it wasn't even spending state NOLs in essence to offset current tax liability. It was actually kind of a pickup of a financial statement benefit. And because of the way that the deferreds worked, we actually picked up over $5 million, closer to $6 million of a deferred tax benefit. As you see on the right side of the screen, based upon the number of legal entities that could potentially be reduced, we toggle that to a savings, and that can vary based on organization, anywhere from maybe $20,000 an entity up to $75,000 or even $100,000, again based upon the types of savings that you would expect to get. Typically, when we see a more regulated environment that requires more of a spend for legal entity maintenance, that those costs get higher. For purposes of this client, we used a $50,000 benefit per legal entity per year that we could reduce. So you can see here, in addition to the cash tax savings of over $2 million, in addition to the financial statement benefit of close to $6 million, we anticipate somewhere in the neighborhood of a $550,000 yearly savings from a legal entity cost perspective. Importantly, this is not an aberration at all. At this point, we have run our tool dozens and dozens of times, and typically what we see is somewhere in the neighborhood of a 50% savings from a separate state tax perspective. So these results are nothing that we really picked out special. This is pretty consistent with all of the scenarios that we've run. So, so with that, I think maybe we can get into a couple of examples that that I'd like Derek to talk about. But before I do, I just want to quickly address a question that I got. How much effort does it take to run this tool? The answer is not much. It's in the data collection realm. Getting out of your tax preparation software, taxable income, modifications, apportionment, getting you the financial statement information. But then once it's in the tool, the tool is nimble enough to be able to run the data effectively, instantly. And so it's really just a data population exercise. And then the tool takes off of that. So we can run it any number of times once we have the data in the tool. So with that, Derek, at very least, I know we want to talk about one of our situations where we've used this tool, but we might want to discuss some other opportunities that we're seeing, particularly with the TCJA and the CARES Act provisions. Derek?
Derek, not sure if you're on mute. We can't hear you.
That's okay. If he joins, great. If not, I'll go ahead and cover it. So Derek, feel free to jump in. One of the really neat scenarios where we've used this tool is in the context of acquisitions. So you're buying a group of companies, and number one, you may want to analyze, is that new group of companies that's coming into the organization, is that efficient from a state tax perspective? Because if it's not, then that may affect, frankly, the purchase price of the group of companies, to the extent that that the state, there may be additional state tax savings. Second, you always have the issue when you're acquiring a group of companies as to where you're going to put that in your organization. And what we typically see is that a company will have an acquisition company. That acquisition company will just bring over the assets or the stock of entities, and it'll just sit off on the side of the org chart. Well, what we can do, if we have the information for the target and we have the information for the acquirer, we can put those together and determine whether there are additional efficiencies that can affect the total organization if we were to structure in a certain way. And those benefits can be pretty significant, again, rising to the level of justifying the price that a company is paying for the target. So Derek, I think I see that you're on. Anything you want to add on that, or on any other stories that you want to tell?
Okay, can you hear me now, Dylan?
I can hear you, yep.
I dialed in to make sure. Yeah, so we used it on a company that one consolidated group acquired another consolidated group. And in any of those scenarios, I'm sure everyone on the call knows the modeling can get pretty ugly when we try to do it in Excel. And where this tool really came in handy was the data sort of analytics that were built in. So we were able to not only calculate their separate state ETRs and try to find some rationalization and savings to get some benefit from this acquisition, but we also were able to use it to layer in sort of all of the current ETRs along with deferred ETRs. And then also, as everyone knows, the unitary sort of analysis. When will the acquired company become unitary? With a couple more formulas put into sort of the tool and the algorithm that it runs, it was able to give all the different scenarios for our client to use to help book their provision. So it was really neat there where we're starting to use our technology in different ways. The other thing that I would mention is we use the tool to also look at some optional filings. And this is something that companies can lose track of. And, of course, it's easy to do in regular Excel for this other point. But looking at some of the other filing methodologies that you can use, such as Nexus consolidated returns in states like Indiana or Georgia or Virginia, to see if you can get some additional savings for the entities that you're already filing in those states. And then also running, if a state has a full consolidated federal style option like Florida or Missouri, things like that, we're able to even get extra benefits for the client. So those are some neat things there. The other thing that I was just going to quickly mention, John, on sort of the restructurings and some of the things that we're seeing right now. I know this was big when tax reform passed. We talked about 80-20 companies, and there are certain entities may be excluded. And we've had two recent examples of that. One was just last week. We had a company that had a Delaware holding company that housed all of its CFCs, and it would basically have a significant amount of GILTI that would have to include in its New Jersey combined return group. And when we looked at the Delaware holding company, we saw that it actually had a disregarded entity underneath it that had operations that were foreign. And we were able to qualify this Delaware holding company as an 80-20 company so that it's excluded from the state combined return group. And with that exclusion, the GILTI that rolls up to that Delaware holding company is also excluded. So something to think about there. The 80-20 companies, it is alive and it does work. And then the other one I would just quickly mention as we run down on time here is Illinois. Illinois has a weird 80-20 rule that we've been looking at. We've been working on for a few years now. But if you make a sale from a domestic corporation to an 80-20 corporation, the sale is eliminated and not taken into account at all for the numerator or the denominator for the combined group's Illinois return. And also the 80-20 company gets kicked out of the return. Of course, if it has Nexus on its own, right, it has to file a separate return in Illinois. But another kind of quirky state rule, statutory, that may be able to give you some benefit. In the case that we looked at, it was able to drive the ETR down for the combined group for this company that has significant deferreds, and was able to produce a nice financial statement benefit for a company this year when they're looking for tax to help drive some savings. So with that, I'll turn it right back over to you, John.
Thanks. And we are running right up against the hour here. So Carol, I think maybe you, Peter, Ann have some closing words.
Thanks, John. I'll take it. Thanks, everyone, for your time. You should see a checkout screen in the poll everywhere. You want to go ahead and check out to conclude the CPE. You will be receiving a follow-up email with a survey that will need to be completed to obtain those CPE. And with the 4th of July holiday coming up here and the June 30 quarter end, we are going to take a little bit of a break from the coffee chats. The next coffee chat will be Tuesday, July 14th. Stay tuned for more details on the topic. Please do feel free to suggest topics in the survey you receive. And thanks everyone for your time, and hope you have a safe and happy 4th of July. Thank you.